Good morning, everyone. It's Shauna, the tax goddess. So today I want to talk about reasonable compensation. Now, this term as a business owner, if you're an S corporation owner or a C corporation owner, your CPA may have mentioned this term to you. They may not have. And if they haven't, side note, time to find a new CPA. Okay, this is a big, very important issue. So what is this? What is reasonable compensation? So, and why is this such a big issue? So let's start with why is this such a big issue? If you're an S Corp, if you're a C Corp, you are required by the IRS to have a wage, not a draw, not a K-1, an actual W-2 wage that you have withholdings on, that you take out your medical insurance from. You know, you are required by the IRC, the Internal Revenue Code, you are required to have a wage. Now, the reason why I'm hitting this so hard, if you're one of the tax goddess clients, I am preaching to the choir, okay? Because of course you have a wage and we make sure that you have a reasonable wage, all right? But I have literally, as a CPA, over my now almost 24 years of experience, had brand new clients come to Tax Goddess where their CPA has said, no, you're not required to have a wage, W-2 wage. No, you can take everything as draws. You know, you guys are going to get in serious trouble if you do not have wages, W-2 wages as an S Corp, as a C Corp. Now, what I want to show you, so we're going to be screen sharing a web report, a website here today with the timeline here. Okay, so why does the IRS care? Why does the government care as an S Corp owner or as a C Corp owner that you have W-2 wages? All right. So W-2 wages, you pay FICA and Medicare. You pay the self-employment taxes on those wages. When you have an S corporation, the other part of your money that comes across as a draw or as a K-1, you do not pay self-employment taxes on. Okay. Now there's a huge push. Biden is out there trying to change the rules. They've been coming after the other part of the money, the K-1 and the draws. They've been coming after that since 2001. Okay. They've been talking about it's not fair. That means S corporation owners and C corporation owners are not paying their fair share of tax. But basically, under the current law, let's just say, make my example easy here, you're making $200,000 a year profit. So not your gross, but after all of your expenses, you're making $200,000 a year profit. So you are required by the IRS to have a wage, all right? So normally Tax Goddess will do 30% of your profit as wages or reasonable compensation. So we're going to get to what that means here in a minute. But 30% wages, so that's $60,000, 200,000 times 30% is $60,000 that you're going to be paying FICA and Medicare taxes on. So the 15.3% self-employment taxes. The rest of the money, the $140,000, it's just income tax. That's it. No self-employment taxes. So the government has been going after this. They've been wanting to get their 15.3% on the rest of that money since about 2001, okay? There was a very particular court case, Veterinary Surgical Consultants versus Commissioner, as well as Joseph Gray, public accountant, CPA, versus Commissioner, okay, about taking reasonable compensation and how much should or should not have this 15.3% self-employment tax on it. Now, the reason why I'm bringing this up, okay, reasonable compensation has been coming up over and over and over and over again, year after year after year. Biden is the first president to actually start talking about, we want that money, right? Now the government has to pay for COVID. We want that money, all right? So what we're here to talk about today, I had to give you a little bit of background. What we're here to talk about today is what is reasonable compensation. Okay, so the IRS has given us some pretty gray rules, and I think that's why sometimes people get into problems here. The two rules that the IRS has given us is either your reasonable compensation is 30% of whatever your net profit is, so 30% of 200,000 is 60,000, that's your wage, or it's whatever you would have to pay somebody else to do your job if you were out of a job for a year. Right? So if you were sick and you had to hire somebody to run your company or do your job or whatever that is, how much would you have to pay that person? Is that 60,000? Is that 100,000? Is that 200,000? You know, how much would you have to pay somebody to do your job? All right. Now, those two rules can be very, very different. So in a $200,000 net profit company, $60,000 in wages, that 30%, okay, $60,000 is a pretty reasonable wage for somebody running a small business, okay? But if your net profit is in the $5 million range, 30% is now $1.5 million. Well, is that reasonable compensation or is that too high? Where does that number fall? So there are actually companies that do what are called reasonable compensation studies. So if you are not sure, if your CPA is not 100% clear that yes, you're meeting the rules and which rule should you follow, the reasonable comp or the 30%, go have a reasonable compensation study actually performed for your company, for your position. How much would you need to pay? Now, here's where all of this gets interesting to me. All right, so I'm going to screen share something here, and it's kind of a little tiny here. So just so you can understand, this is a really good timeline of what's been going on with this reasonable compensation program here. Okay, so you can see back in 2000, the IRS establishes its authority to reclassify distribution as wages. So what's really happened here, guys, is that the IRS came into a company, and that's Joe Lee versus Commissioner. You can see it there. The IRS came into a company and said, listen, you're making $200,000. You only took, for example, $10,000 worth of wages. That's not even close to our 30% number. We're going to look at how much in distributions you took and how much you took on your K-1. And we're going to reclassify some of that as wages. You now have penalties, interest, late filing, late payment, penalty, plus the tax that you have to pay on that, okay? And the reason why I wanted to show you guys this timeline, so let's go back to the full timeline here, is you can see that this is now becoming more and more and more frequent, right? 2000, 2001, 2002, 2005, 2008, 2009, 2010, 2011, 2012. This is now becoming every single year. There are court cases, there are adjustments, there are taxation things that are happening to business owners for not doing this properly, okay? Now, you'll notice here, 2020, this was the year we got hit with COVID, of course. The IRS was about to go jump on everybody. Right at the beginning of 2020, this actually was supposed to be coming out in February. It didn't get released because of COVID, of course, but this is now, the IRS is now making reasonable compensation compliance one of their serious, we're hunting people, we're coming for it, okay? So why is Tax Goddess bringing this up to you, okay? Why do you care about reasonable compensation? At this point, okay, you need to make sure that you are taking reasonable compensation to meet one of those two rules, okay? Either 30% of net profit or reasonable compensation per a reasonable compensation study. Okay, so no more of this, well, I think my job, I would only have to pay $20,000 to. Do not fall under this idea that you can just pull a number out of thin air. Okay, it's either 30% minimum or it's reasonable compensation via a reasonable compensation study. So how do you get around this? How do you keep your wages as low as possible? You guys know I'm all about the tax tips, okay? So how do you keep your wages as low as humanly possible, therefore keeping your self-employment taxes as low as possible? Tax strategy, right? If your reasonable compensation is based on the net profit of the company, okay, let's try and get the net profit down. Okay, so what strategies can we use to reduce the net profit? So you guys have heard me talk about the DST. You've heard me talk about an accountable plan. You've heard me talk about the SRA. You've heard me talk about paying your kids. You've heard me talk about the rents, right? The master's exemption rents. So, and if you haven't heard that, go check out our YouTube channel, for Tax Goddess on YouTube. We're very easy to find. We have tons of videos on these subjects. But the point for this particular video, okay, look at your tax returns. If you're a Tax Goddess client, you're safe. We make sure that you are covered. We make sure that you are safe, okay? There are CPAs out there who are just signing off on tax returns. CPAs, side note, if anybody's a CPA watching this, CPAs, you guys need to be watching this too, okay? The IRS has specifically said that they're now going to start going after CPAs that are not watching and properly reporting reasonable compensation for their clients. So this is actually a CPA penalty as well if it's not done, Okay. So guys, I am all about being aggressive. You know that, but this is one of the few areas. Don't muck around. Don't muck around. There's since 2000, the IRS has been coming after reasonable compensation. So please, 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 if you have any questions on reasonable compensation, how to drop your profit so that your reasonable compensation can be lower, or any other questions the Tax Goddess can answer for you, reach out to me and the team at Tax Goddess. So just go to taxgoddess.com and you can book an appointment with any of our fabulous team members and we can see how we can help. So thanks so much, everybody. I hope you guys all have a great day, and please share. Please share this. This is a very particularly important message. So if you have any other business owner friends, Tax Goddess would love to help, would love to spread the knowledge and get the word out there. So thanks, everybody. Have a wonderful day. See you guys later. Bye.